Welcome back to Analyst Bites. In our last video, we broke down the core logic of CFO and cleared up those tricky positive and negative sign traps. Today, we are moving on the next level. Now that we understand CFO, how do we tackle FCF, free cash flow? Actually, whether you are calculating FCFF or FCFE, there are two old friends that always show up in the formulas. The first one is a little ghost that often hides in the accounting books, NCC. The second one is a little bump that can easily trip you up if you are not careful, the working capital investment. In this video, I will keep using straightforward concepts along with real questions to help you fully master these two areas. Alright, let's dive right in. To truly nail NCC, we first need to separate it from regular depreciation. Take a look at the income statement waterfall on your screen. A company's earnings start at the very top with EBIT, EBITDA. First, we deduct depreciation and amortization to flow down to EBIT. Next, we subtract interests to reach EBIT. And finally, we deduct taxes to land at the very bottom, net income. Look at this waterfall. Remember one golden rule. If it hasn't been deducted, you don't need to add it back. You see, besides standard depreciation and amortization, there are two special NCC items hiding in interests and taxes. Since EBIT is higher up, it hasn't touched them yet, but net income has already deducted them. The first one is bond amortization, which is baked into the interest expense. To keep it simple, let's use the liability rule to understand it. For a bond issued at a discount, the company has to pay back a higher face value later. This means during the amortization period, the company is essentially borrowing more money from creditors. Borrowing means cash inflow, so we add it back. Conversely, for a bond issued at a premium, the company is effectively repaying debt, which is a cash outflow, so we subtract it. The second one is a change in deferred taxes, which is baked into the tax expense. As we learned in Level 1, an increase in deferred tax liabilities means you are paying less tax right now. Treat this as an interest-free loan from tax authority. You owe more money, which is a cash inflow, so we add it. On the flip side, an increase in deferred tax assets means you paid tax upfront. That's a cash outflow, so we subtract it. Now with these two hidden items cleared up, the FCFF formulas make perfect sense. Why do we only add back depreciation and amortization when starting from EBIT? Because EBIT is upstream. It never deducted those two items in the first place. But starting from net income, at the very bottom of the waterfall, all non-cash charges have been taken out. So you must add back the full NCC. Quick side note, things like impairment of intangibles, gains or losses on asset sales, and restructuring charges are also part of NCC. But these are older topics from Level 1, so just keep them in the back of your mind. One last detail. When calculating FCFF, we don't add back after-tax interest if we start from EBIT, but we do if we start from net income. Why? Same exact logic. FCFF belongs to both shareholders and creditors. Look at the waterfall. EBIT is above interest, so it never deducted it. No need to add it back. Net income, however, already subtracted the creditor's interests, so we have to add it right back in. Concepts can feel abstract if we just talk about them. So let's jump straight into practice and turn these rules into muscle memory for the exam. Look at question 1. We need to calculate FCFF for Alpha Company. When reading the question, you might notice a detail. The examiner gives us both net income and CFO. Feels like too much information, right? Actually, this is a classic smoke screen. Let's try it from net income. Because the question only explicitly gives depreciation. Many students will just assume only NCC is depreciation. But if you calculate FCFF using net income plus depreciation, you get 545. Look at the choices. That answer isn't even there. Why? Because the question secretly hides other NCC items. Adding only depreciation doesn't give you the full NCC, so your math will be wrong. But what if we switch gears and start directly from CFO? The result is 525, which perfectly matches choice B. This question gives us a major pro tip for the exam. The CFO figure naturally has all NCC items baked in. So in the future, whenever you see both CFO and net income in a question, always start with CFO. You will bypass the hidden NCC minefield and get it right in one step. Moving on to question 2. This one asks us to calculate FCFF starting from both net income and EBIT. This is a tailor-made drill for the waterfall rule we just covered. Look at the data. Besides the standard depreciation, those two easily ignored little NCC ghosts popped up again. First, amortization of bond discounts. Apply our liability rule. A discount means the company is constantly borrowing money. Borrowing equals a cash inflow, so we add 20 back. Second, an increase in deferred tax liabilities. Apply our tax authority loan rule. An increase in DTL is like an interest-free loan from the taxman. You owe more money, which is a cash inflow, so we add 30 back. Alright, now let's start from net income. Since it's at the bottom, all non-cash items have already been deducted, so we need to add all three NCC items back. Depreciation of 150 plus bond amortization of 20 plus DTL increase of 30. Plug the full NCC into the formula, add back the after-tax interest, subtract working capital investment and fixed capital investment, and you get exactly 650. Let's verify this by starting from EBIT. Remember, EBIT is upstream. It hasn't deducted interest and taxes yet, so we completely ignore bond amortization and DTL. Just add back depreciation. Similarly, it hasn't deducted interest, so there is no need to add interest back either. Run the numbers, and the result is still 650. Both passes meet perfectly. After this question, the differences between starting from EBIT, and net income should be fully locked in your brain. That's a wrap for this question. Let's look at the next question. It's adapted from an end-of-chapter question in the official curriculum, even though it touches on net borrowing, which we will cover in the next video. It's actually testing the NCC concept we just talked about. That's why I put it here. Let's read it together. An analyst plans to use this long formula on the screen to forecast FCFE. The question asks, based on the table, which company can actually use this formula? The breakthrough is in the formula itself. Look closely. It starts with net income, but in all those deductions, the only non-cash charge you see is an isolated depreciation. This exposes the formula's fatal flaw. This formula only works if a company's NCC is strictly limited to depreciation. If there are other non-cash items, the formula breaks down. With that in mind, let's check the table. Company B has extra NCC from DTL. Company C has an NCC from a bond premium. Only Company A has a completely clean book. No hidden NCC other than depreciation. So the answer is A. Simple as that. Last question brings up a very specific formula for forecasting FCFE, which I listed here. Many students get confused when they see this DR formula. They wonder, where did net borrowing go? And where did this 1 minus DR come from? Don't panic. Let's clear this up right now. First, DR stands for target debt ratio, specifically debt to asset. As we learned in Level 1 corporate issuers, every company has an optimal capital structure. At this target ratio, the company's overall cost of capital, WACC, is minimized. Think of a company's future expansion like building a factory. The total investment needed to build it comes from two parts: new investment in working capital investment and net investment in fixed capital investment, which is fixed capital investment minus depreciation. Added together, this is the company's total future capital requirement. Here is the key. Because the company plans to finance this using its optimal capital structure, let's say fixed at 60% debt and 40% equity. It's like requiring this factory to be built with 60% gold blocks and 40% silver blocks. Those 60% gold blocks, which is DR multiplied by total capital requirement, represent the money the company plans to borrow from creditors. That exactly equals your future net borrowing. If you plug this net borrowing back into the basic FCFE formula and group the terms, you perfectly derive this formula. The 1 minus DR is simply the 40% silver blocks, the portion of the net investment that shareholders have to pay out of their own pockets. Finally, I must emphasize the two strict rules for using this DR formula in the exam. Number one, just like I said before, its fatal flaw is that it must assume depreciation is the only non-cash charges. Number two, this formula is strictly forecasting the future. It assumes the company will hit its ideal target capital structure. Do not use the company's messy historical debt ratio to calculate historical FCFE with this formula. It won't work. This exact trap has tripped up many students in the end of chapter questions, so make sure you avoid it. Now let's look at the final question of the first half. This one has a slight twist. The question didn't give us EBIT or net income. Instead, it started right at the top of Waterfall with EBITDA. Remember our income statement waterfall? EBITDA is at the very top. What's the difference between EBITDA and EBIT? Exactly, it's just depreciation and amortization. So the logic is simple. Subtract depreciation and amortization from EBITDA to find your EBIT. From there, just plug it into the standard EBIT formula we just mastered. Plug in the numbers, and the answer is 410. Choice B. Easy. Alright, through these 4 practice questions, we've now dissected FCF formulas starting from CFO, net income, EBIT, and EBITDA. We've cleared the tricky NCC traps and even cracked the logic behind the target debt ratio. That covers the heavy lifting for the first half of this lesson. Go grab a coffee and let your brain reset for a moment. When we return, we are going to tackle a potential ticking time bomb: working capital investment. Welcome back. Let's keep moving. In our previous video, we looked at working capital investment from a cash flow perspective. Today, we are switching to the balance sheet. Take a look at the formula. Working capital investment is simply the change in working capital. And as you know, working capital equals current assets minus current liabilities. But here is a catch, and this is where candidates often slip up. Not all current assets and liabilities make the cut. First, we must exclude cash from our current assets. Why? Think about it. The entire goal of the cash flow statement is to calculate the change in cash. Cash is our final destination. It is the result we are looking for, not a variable we use to get there. So we leave it out. Second, we exclude all interest-bearing debt from current liabilities. This usually means things like notes payable or the current portion of long-term debt. Why? Because these are financing activities. They belong in the net borrowing category, not in the day-to-day operating cycle. Look at this picture to help you remember. Only 2 operating items pass the scanner, like inventory, accounts receivable, accounts payable, unearned revenue, wages payable, and so on. And please keep this in mind. Cash is the result. Debt is financing. Only the remaining operating items are pure enough to enter our working capital investment calculation. Now that we've set the rules, let's head into the exam room. Look at this example. We have the balance sheet items for Delta Company over 2 years. Our mission: find the working capital investment for year 2. Remember the scanner? The moment you see cash and notes payable, filter them out immediately. We only want the pure operating items. For year 1, by calculating all the real operating assets and liabilities, our working capital is 100. By year 2, it grows to 135. The difference, our working capital investment, is 35 million. That leads us straight to choice B. See, Once you pass the scanner correctly, the math itself is effortless. Now let's tackle the second question. The examiner is stepping up the game here. Instead of giving you the clean breakdown, they've given you the totals for current assets and current liabilities, then sorted data with noise, cash, and interest-bearing debt. Our strategy? Strip away the noise. For each year, working capital equals current assets minus cash. Subtract the current liabilities minus debt. Run the numbers, and you will find the working capital is negative 70. Watch that negative sign closely. It means working capital actually dropped. When you plug a negative 70 into the FCFF formula, it's a double negative, plus 70. So the final answer is 450. Choice C. But let's talk about the why. Why is a decrease in working capital a plus? Think of it as inventory liquidation. A drop in working capital means the company isn't dumping new cash into assets this year. Instead, it's burning through assets built up in the past to fuel current operations. It's like pulling old stock off the shelf and turning it into cash. That's a massive cash inflow for the business. So, a negative working capital investment literally means assets are flushing into cash. From a cash flow standpoint, we add it back. Simple as that. Let's move on to the next question. This one is a great reminder of the relationship between CFO and working capital investment. Remember the four-quadrant map from our last video? The essence of CFO is simple. You start with net income, add back the non-cash charges item, and then subtract working capital that was tied up in operations. When you put these pieces together, you get your CFO. The twist here is that the examiner didn't give you working capital investment directly. Instead, they give you the CFO and asked you to work backward. As long as you get the NCC right, this point is in the bag. Take a close look. The NCC here isn't just depreciation. There is also a 20 million amortization of bond premium. Using our liability rule, premium amortization is a subtraction. So your total NCC is 120 minus 20 equals 100. Now just plug that 100 into our formula. A quick calculation shows that working capital investment is 120. Choice B. Done. Alright, now that we've covered the theory and exam questions, let's step into the real world of business. Remember that Starbucks cash flow statement from our last video? Let's put on our analyst hats and calculate Starbucks' actual working capital investment. Take a look at the pink box on your screen. It includes accounts receivable, inventory, accounts payable, deferred revenue, and so on. These are purely operating items. As you might remember, Starbucks uses a textbook standard cash flow statement. Parentheses means cash outflow, and positive numbers mean cash inflow. So if we just add these numbers straight down, keeping their signs, the total impact of working capital on cash flow is a negative 1,494.4. Now here comes a classic exam trap. Think about it. When calculating FCF, Can you just plug this negative number straight into the formula, turning it into minus a negative 1494.4? Absolutely not. You have to understand the common sense behind the formula. The logic here is completely different from what we saw in question 2. This negative number already tells us that Starbucks literally paid out this much cash to expand its working capital. That negative sign is the minus sign in your FCF formula. If you subtract it again, a double negative becomes a positive. The meaning completely flips. It would mean Starbucks didn't invest cash, but actually cashed out by selling off its working capital. So remember, when dealing with a real cash flow statement, a negative sign usually means an outflow. Just use the net number. Do not double deduct. Now that we've cleared the working capital investment sign trap, let's glance up at the yellow box. This is Starbucks Real World NCC package. You will notice that in the real world, NCC is way more than just depreciation and amortization. Here we see the deferred taxes we just talked about, and a very common one, stock-based compensation. Giving shares to employees doesn't spend actual cash, so it's a non-cash expense. You also have asset impairments, losses on disposal, and so on. To sum it up, NCC is simply the collection of all items that reduced or add your profit without touching your actual cash balance. Add them all together, and Starbucks' total NCC for the year is 4,385.2. When calculating FCF, you just confidently add this entire amount right back. That wraps up the entirety of part 2. In this video, we successfully cleared the two biggest minefields in the FCF formulas, NCC and working capital investment. Next up, we are heading into the final chapter of our FCF series, part 3. In the next video, we will put the last two puzzle pieces in place: fixed capital investment and net borrowing. Once we cover those, your entire FCF framework will be 100% complete. Of course, beyond the core calculation, I will walk you through two classic exam traps. First, what is the actual difference between the present value of FCFF and the true firm value? And second, that classic illusion that gives so many students a headache. Do dividends and share repurchases actually affect FCFF and FCFE? I'm Analyst Bites. Every problem here is to help you ace the exam. Every insight is to help you see through the business world. Let's take the CFA out of the textbook and into your real life. Thanks for watching. I will see you in the next one. Bye!